Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, July 3rd, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro events are Powell reiterates patience, Frexit risk continues to decline, commodities in no man's land, and disconfirming evidence of our resilient U.S. economy and green shoots globally themes. In terms of market implications, after helping clients make a ton of money by calling for and maintaining conviction in the bull run since early November, we, the economy and asset markets, have arrived at a transitional crossroads. As a result, we currently lack conviction in what the modal market regime will be throughout the second half of 2024. We can paint a credible case for Goldilocks, which includes positive growth surprises and negative inflation surprises in the U.S. contributing to a weak dollar. We can create a credible case for inflation, which includes fears of Republican sweeps' impact on the structural debt outlook and hawkish net financing policy equating to rising real interest rates. And we can create a credible case for deflation, which is slowing U.S. and global growth plus slowing U.S. and global inflation equals negative U.S. and global earnings revisions, which ultimately forces investors to crowd into mega cap growth here in the U.S. and treasuries. So each of those three regimes are relatively reasonable probabilities. And so ultimately, we are looking to catalysts like the Q3 quarterly refunding announcement, which may help resolve the debate if other leading indicators fail to declare sooner. If there is a signal to interpret from our current lack of conviction, it is that investors should not be leaning too heavily in either the bullish or bearish camps at the current juncture. Beware of research partners that operate with maximum conviction all the time, because selling snake oil helps them make money, not you. Thank you. So we'll wrap it up as always with our 42 with the question from our 42 macro dashboard, our community feature here in the dashboard, which has been popping lately. So very grateful for that, and really very grateful for the fact that we have thousands of investors all over the world, not only interacting with me, but interacting with each other, helping each other out, showing each other, sharing interesting tidbits and takes and media and resources to each other, all with the singular, goal of helping each other grow as investors and helping their portfolios grow. So this one is not really a question, but I thought it was a great opportunity to expound upon our positioning model. So this one is with regard to levered ETFs and margin debt for positioning. So Warren Pies, our friend Warren Pies, former guest on our Pro to Pro Live, we'll have him back again in the future, talked about one of his favorite positioning and sentiment indicators being aggregate, inverse, and levered ETF volume. He notes using margin debt in the past, which this person also sees folks like Fundstrat use a lot, but that lots of that activity has shifted into the levered ETFs now. It's a very interesting discussion. So I agree. Margin debt, levered ETF volumes, these are all things to track. But most importantly, when you're tracking positioning or tracking sentiment, you have to do it in a systematic way or it's useless. So, and what we mean by that is, so let me just take show an example from our positioning model here, which we use to assess the probability of significant reversals in momentum across asset markets over multiple time horizons. And how our positioning model is structured is we're looking at a compendium of indicators, for example, the AII Bulls Bear Spread, the NAAIM, National Association of Active Investment Managers stock allocations, the AI stock allocation survey, the bond allocation survey, the cash allocation survey. We aggregate non-commercial net length divided by total open interest for the U.S. equity market across all the futures and options that the CFTC keeps track of for U.S. equities. We do the same for U.S. Treasuries across the curve. We do the same for the U.S. dollar against all major currencies in gold. And then we do the same for all the 19 components of the CRB index. We also track realized volatility as a proxy for systematic fund exposure. We track implied volatility correlations as a proxy for market neutral hedge fund exposure. And then ultimately we track valuations as a proxy for aggregate sentiment and positioning in the market. And so going back into this concept of tracking it on a systematic basis, one of the things we do that's differentiated and valuable for our clients is we understand how these sentiment indicators have performed around major bull market peaks in the S&P 500 and major bear market troughs in the S&P 500. So in terms of identifying critical inflections in momentum across asset markets, what we're trying to do is see if the positioning indicator has currently breached the threshold that is historically consistent with either a major bull market peak or a major bull market bottom. And then once we accumulate those types of signals, then we can make a high conviction call on, okay, this is a good spot in the positioning cycle to get longer of risk or get longer of a particular asset class, or this is a bad spot to get a longer of risk or longer of a particular asset class. And with respect to the medium to long term duration on risk management terms, that's 3 months, anywhere between 3 months to 12 plus months in terms of risk management. 5 of the indicators that correspond to U.S. equities in particular have all breached the threshold that is historically consistent with major bull market peaks in the S&P 500. The only 2 that correspond to U.S. equities that are not breached their peaks are the U.S. equity non-commercial net length divided by total open interest, and then the AI bond allocation, which is pretty close to the median value that is historically breached at these major bull market peaks, i.e., not having enough bonds in your portfolio, which has been historically consistent with major bull market peaks. So this is something, in our opinion, this is a better mousetrap than, in our opinion, than what we're observing out there in broader financial media. And recall that this is the model that helped us at the beginning of November call for the beginning of the bull run that our clients really experienced on the long side of risk assets and made a ton of money, as we highlighted. And we're very grateful for that because, again, what we're trying to do here is systematically track positioning, sentiment, flows, et cetera, in a way that allows us to make high conviction inflection calls in market momentum. And this is this model is signaling some things today in terms of the forward-looking the negative forward-looking outlook for risk. But again, it's not the only model that we use to help investors guide their portfolios. It is one of a compendium of tools, and then obviously I myself, using my human intellect and my experience and acumen, help kind of piece the puzzle together in a way that creates clear, actionable signals for our clients. And generally speaking, those clear, actionable signals help our clients make a ton of money. You can check the facts on that. So we'll wrap it up there. Darius Dell presenting our macro minute for Wednesday, July 3rd, 2024. Everyone have a wonderful day out there. Best of luck, and we'll catch you back here tomorrow. Cheers. Actually, no, we won't catch you back here tomorrow. It's 4th of July tomorrow, so we'll catch you back here on Friday. So happy 4th of July. Happy America's birthday to everyone out there celebrating. And I think it might be Boxing Day in Canada. So shout out to my Canadian clients and friends out there as well. So happy Boxing Day. Happy 4th of July, and we'll catch you back here on Friday. Cheers.